Hello, let's take a look at how to calculate interest expense, calculate the change in carrying value, and calculate the carrying value for a discount bond. We'll use a face value bond of $1,000, a stated rate of 10%, maturity of 5 years with semi-annual interest payments. With semi-annual interest payments, you take the stated rate of 10% divided by 2 and you use 5% each period. For the cash flow periods, you take the 5-year maturity, multiply it by 2, and you get 10 cash flow periods. For this problem, we're going to use scenario 2, where the market interest rate is 12%. Because of the semi-annual payments, we'll take the 12% divided by 2 and use 6% in our calculations. This is a discount bond because the stated rate is less than the market rate. Anytime the stated rate is less than the market rate, when you issue your bond, you'll receive less than the face value of the bond. That's why it's called a discount bond. In this case, our face value is $1,000, but when we issue the bonds, we're only going to receive $926.40. We're going to receive $926.40, which is less than $1,000 because the stated rate is 10%, while the market rate is 12%. By receiving less and paying back $1,000 at maturity, the investors will receive a 12% return on their money. Our amortization table has columns for period, cash interest payment, interest expense, discount amortization, which is also the change in the carrying value, and carrying value. At time period 0, which is today, the value of the bond is $926.40. If we look at the cash interest payment column, $50 is entered for all 10 periods. The $50 is always based on the face value and the stated rate of interest. To get the cash payment in this problem, we multiply the 1,000 by 5% to get $50 for every semi-annual period payment. That doesn't change, and that's referred to as an annuity. To get the interest expense, we multiply the market rate of interest for the period by the carrying value of the bond. So for the first period, we'll multiply 6% times $926.40. We'll get $55.58. The difference between the cash payment and the interest expense is the change in the carrying value, or it's the discount amount to be amortized. The difference between the two is $5.58. To get the carrying value for the bond at the end of the first period, we take the $926.40 and add the change in the carrying value of $5.58 to get $931.98. You will see that for a discounted bond, each period we add the change in the carrying value to the prior period's carrying value. The reason for adding the prior carrying value to the change in the carrying value is so that by maturity, the bond value reaches the face value in this case $1,000. So when we do carrying value calculations for discounted bonds, we always add the change in the carrying value to the prior period carrying value. For period 2, our cash payment again is $50. The interest expense for period 2 is $55.92. We multiply the market rate of 6% times the prior carrying value of $931.98 to get the interest expense of $55.92. In order to determine the change in the carrying value or the amount of the discount amortized, we take the difference between the cash payment and the interest expense, which is $5.92. We add it to the prior carrying balance of $931.98 to get a new carrying value of $937.90. For period 3, again, we send $50 out in interest payments to our investors. We calculate the interest expense, however, at $56.27 because we're multiplying the market rate times the prior carrying value of $937.90. When we multiply 6% times $937.90, we get $56.27. The change in the carrying value of $6.27 is the difference between the interest expense calculation of $56.27 and $50 in cash interest payments. We add that $6.27 to the prior carrying value of $937.90 to get the new carrying value of $944.18. We do the same type of calculation for periods 4 through 10. The cash payment column will always be $50. The interest expense column will always be the market rate of 6% multiplied by the prior period's carrying value. The difference between the interest expense and the cash interest payment will always be the change in the carrying value. The change in the carrying value will always be added to the prior period's carrying value until we reach period 10, where the carrying value of the bond will equal the face value of the bond, $1,000. That's it. You can solve these types of problems with just equations instead of using an amortization table. Test questions will not ask you to do a complete amortization table on a bond. They'll typically ask you to solve for 1, 2, or 3 periods. To do the calculation for period 1, you would take $926.40 carrying value, multiply it by the market interest rate of 6%, and you'll get the interest expense for the period. You take that interest expense for the period and subtract it from the cash interest payment, and you'll get the change in the carrying value of the bond, $558, just like you did with the amortization table. You'll add the $558 to the beginning carrying value to get a new carrying value of $931.98. For period 2, you'll start with the $931.98 carrying value from period 1. Multiply it by the market rate of 6%, get the interest expense of $55.92. The difference between the interest expense and the cash interest payment is the amount that the carrying value will change. It's also the discount amortization amount. The $592 gets added to the carrying value from the beginning of the period to get the ending carrying value. The ending carrying value becomes the beginning carrying value for period 3. You multiply that by the 6% market rate, and you get the interest expense for period 3. And you see that the amounts are identical to the amortization period. The difference between the cash payment and the interest expense is the change in carrying value. The change in the carrying value is added to the beginning of the period carrying value to get the end of the period carrying value. So again, you can do these calculations with equations. You're calculating the interest expense, the change in the carrying value, and then the new carrying value for the bond. The carrying value for the bond always represents the bond liability. The face value of the bond represents the bond payable. So that's it. I hope this helps you understand bond calculations a little bit more. Thanks for viewing.